Welcome to the New Barbarians Podcast. I'm Bill Mann.
And I'm Mark Connors. And we're here to deliver insights on how current macro trends and market events have changed the value proposition on traditional assets like equities and bonds, the things Bill and I grew up trading, investing, and researching over the last 25, 30 years. Instead, we think it's digital assets that are setting the new financial and investment frontier for investors like you going forward.
We're also here to explain how cutting-edge tools like AI and disruptive tech are the new barbarians at the TradFi gate.
So hit the subscribe button on your favorite podcast platform, and let's cut through the noise together.
Welcome to the New Barbarians Podcast. This is episode 11. Today is Monday, March 10th, 2025. This podcast will hit platforms later today. This past new normal volatility week, we witnessed the sell-off continue. Uncertainty around tariffs that went into effect, but then were delayed until April 2nd. I'm looking at pre-market equities and performance across risk premium factors. Futures in the U.S. are down 1.5% to 2% across the board. Europe is down over 1%. Asia's down, China's down, and Japan is up slightly. Big news last week, the Atlanta Fed's GDP nowcast turned negative for the first time since 2022. On Monday, the estimated Q1 2025 GDP growth rate turned even more negative, falling to negative 2.8% from Friday's negative 1.5%.
And then, Bill, even on that point, I think February 28th, the week before, might have been a positive print, if not late Feb. So we had like a 4% turnaround in a matter of 2 weeks.
Yeah, I remember when you brought this up and you said no one was talking about it. I actually didn't believe you for a moment, and then you showed me, and the revisions around economic data and therefore policy around the data is confusing me, and I'm looking forward to talking to you more about that today. So the trade deficit is widening as a result of tariffs. Rising 34% from the prior month in January to 131.4 billion. It looks like importers are front running the tariffs, but
yep.
This is certainly an interesting time. And with that, I will let you tell us what's going on, Mark.
All right. It's definitely been a macro market. My estimation is that we are in the third inning of a sell-off. We hit correction territory on Thursday in the NASDAQ, down 10%. A bear market is considered down 20 from peak. And ironic or not, the peak was set in on February 19th, right around the 5-year anniversary of the start of the sell-off in the COVID period. So people think we have cycles every 5 years. Well, we haven't had many recessions, but a market bloodletting is underway for sure. So let's go to some slides that we set up here. Always like to look at the scorecard, what the market's saying the winners and losers are, which follow a little bit of the trajectory that Bill laid out on what's happening in the markets. Equities down. So what you're looking at here is a graph from our COIFIN dashboard. And the winners year to date have been gold. And gold is up 11% through Friday after posting a 28% gain in 2024, besting the S&P. Gold has beat the S&P 2 out of the last 3 years, 3 out of the last 5 years. The last time it did this, 2 periods. One is going into the global financial crisis. Uncertainty reigned. People went to gold. Inflation or debasement occurred. And obviously gold volatility and price went up. The other period is the 1970s. So we beat that drum up and down on these broadcasts because that's a period we think is the best analog, and we'll leave that alone for now. But the other one, out of the blue, pun intended for the EU, is this Stocks 50 up 13%. So Europe is up because of its low PE, seen as a safe haven, not the 22 PEs that we have in the US. And then we have bonds up, yields down. Thank you, Scott Besson, having a good week, getting his prediction and his mandate of lower yields coming to fruition. So there is a method to their madness to a degree, but we'll talk about it potentially becoming a little bit unwieldy as far as the Trump negotiation of tariffs to get his goal of more growth, weaker dollar, even though they say stronger dollar, and lower rates because they have over $10 trillion, as Kevin Jang, one of our guests, said, to refinance this year. $10 trillion in debt is being refinanced. And right now, if you don't move anything, Bill, it's going to be refinanced 180 basis points higher right here because it's coming off of like a 2% or so average coupon between the bills and the bonds that are coming due. And the current rate environment's 4.5. So they got a lot of wood to chop in order to reduce their interest expense. It's guaranteed to go higher unless they move lower, even from here. All right, then we'll end up with a scorecard, obviously. Crypto and equities in the red, with Magnificent Seven down 11% after being up 64% in 2024.
And, you know, I think almost across the board, Wall Street outlooks, you know, weren't super bullish on AI and the Magnificent Seven and, you know, the tech run. But, you know, I think for the most part, things were supposed to kind of continue positively, at least. You know, we weren't going to see 24% runs in the U.S. stock market in 2025, but things were positive. The negative 11-12% for the Mag 7 seems significant, as well as the overall stock market. I think one thing that I guess I have to look at is Europe, right? So we see people shifting to Europe and to safer stocks, but you know, what happens if Europe sells off? So, you know, maybe what we've seen is some deleveraging, but the real panic maybe isn't there until people sell all equities.
So I totally agree, Bill. I mean, the Stocks 50 is a fraction of the size of the S&P, let alone the Mag 7. So the money that flew into that is not great. I think it's a $4 trillion index. S&P is, you know, at the start of the year was 56 trillion.
Okay.
So so the fund, so we just, I mean, that's why the dollar is a reserve currency, because there isn't a vehicle out there that can really handle investment or trade. It's U.S. equities and U.S. dollar. You know, it's being chipped away at. So I agree with you that we're not even, again, third inning, I said, on the downturn. But, you know, I'm talking global macro, big picture, fundamental investing. When I was at Credit Suisse dealing with firms like Two Sigma, Citadel, you know, Millennium's Quant Arm and others, you know, there was a term called getting low to ground, because clearly not all this was in the data. So how would a quant firm, do they take in the fact that maybe Europe's the place to go and they start rolling into it, or that country risk is all of a sudden very different? The U.S. isn't the prettiest equity in the block and they should all of a sudden dive into Europe on Tuesday because it's better? How does a quant firm allocate in such a time of turbulence?
Great question. And it's going to take me a minute to answer. So,
all right.
I think, you know, first of all, you know, we're going to talk about, you know, multi-strategy, large quants that are invested across regions, first of all, or else, you know, they can't do that. And then, you know, there is natural rotation among maybe organic rotation among factors and regions based on returns and risk. Like you usually follow good returns, and then you kind of take down risk when it rises and you're losing money. So I think the answer is, you're going to dial down risk in the U.S. because volatility is way up and, returns are down. So sort of by definition, these aren't things that are predicted by historical relationships that you're going to be betting on with the majority of your models. And then, quants don't really have a toggle that says, like, let's shift out of the US and into Europe. That happens more naturally, just based on returns and risk. But even if they did, I think we just answered the question. It's a much smaller market, and if Citadel, Two Sigma, AQR, Bridgewater, like you name the other, hedge
monsters.
fund with tens of billions of dollars, they're gonna fill that coffer up pretty quickly, and then capacity and trading costs would be way up, and so the answer I think is really that they cannot. However, smaller emerging quants and fundamental investors, I think, can take advantage of some of these things. But the other thing is you manage risk and alpha portfolios regionally, right? So you're usually looking for a relative value within European stocks. It's not European stocks versus the US, although that could be a strategy that you implement. And hopefully you did have such a strategy, so you can bet within factors across regions and things like that. But typically you're going to manage risk and return and alpha within a region.
Got it. So you're not going to be long. So what we're looking at here is what I think is one of the biggest unique. I would say that this graph characterizes this graph characterizes what's going on now, why this period is unique. It's not like 2008. It's not like COVID. It's not like the Plaza Accord, which is what people are saying is going on now, that we have a new currency regime being written actively and thoughtfully by the Trump administration in order to change the relationship of the dollar and trade. What you're looking at is a absolute cleaving in two of valuations in Germany versus the US. So name the last risk-off period where you had the US dollar go lower and euro go higher. It's implicit in this graph, it's not explicit. What you had in Germany is you had the DAX, the German stock market, go up 22% year to date. The yields jump 31 basis points in one day, the biggest move since 1997. And all the while, the US 10-year is just moderating around here at a level that, really hasn't jumped a lot.
And so sorry to jump in, Mark, but the graph here, especially for our listeners, can we just explain what we're doing? We have year-to-date returns for bonds and equities.
No, so it is, thanks for clarifying. What I did here in order to show the behavior as a uniform movement is for the bonds, the German Bund, I showed the yield. The yield has gone up 20%. So it's gone up, from 2.2 to 2.8%. And the US yield 10-year has gone down. So the price on the German bond is lower and the price on the US bond is higher. I did yields in particular to show really what I think is happening, which is an inflationary factor is being priced into Germany that we've not seen not prior to '08.
Right.
I mean, maybe going. I mean, since '97, really.
It's always tricky doing, percent returns on a percent, like a yield, but
Someone should throw a flag at me. I did it knowing that I was breaching certain decorums and protocols by conflating a yield return versus a bond. So yes, thanks for throwing it at me. I deserve that laundry in my backfield. I definitely.
I wasn't calling you out. I actually think it's an interesting illustration about of how these are very related. So I think when you do see percent on, percent changes, which is kind of, we're going to flip it over. And I think if we had inverse a price or something, we would probably get a similar graph. But yeah, I think that this is very interesting, especially because we're in risk off. But what we really just see is a total divergence in both bonds and equities. Europe good, US bad.
Yeah. US. Yeah, and so on the equity side, it absolutely is. And I think what this shows me, and the reason why the reason I like these podcasts is because, even though we write over the weekend and we try to hone our ideas, what we're looking at here is great. Europe's up, good, but why is it up? Germany still has a negative replacement rate on its population, negative. Ex-immigration. It has almost zero growth, low growth. Its manufacturing sector has been hollowed out. So what do? They say, well, Trump's not going to give us any more arms. We need to create an army for the first time since, radio existed, not television, prior to World War II. And then we have to redo our infrastructure for manufacturing. So that fiscal stimulus caused yields to go higher, bonds lower. Think of UK, the Liz Truss moment back in 2022, where she said we need to stimulate. So Europe is going to use a printing press. That's why the yields are higher. And I think that's why equities are higher, not because of growth, because they say inflation's coming. Like, remember Argentina when it started to hyperinflate? The equity market was like up 80%, but that was in terms of local currency. So this is not great. I think that it is indicative of higher prices. And the question is, what Maria Bartiromo tried to get out of Donald Trump is, what's the plan for tariffs? Will you pull them out if people agree? Do you understand the potential of a recession? And if that happens, what would be your plan then? I know that was a lot, but there's a lot going on here, Bill.
And Mark, was the answer to that question straightforward and answered to your satisfaction?
No. So the answer to the question is, do not get sucked into the higher returns in Europe. They're fleeting, they're reactionary, and they're based on inflation and not a growth engine of good industry driving earnings on a stable consumer in Europe by any stretch.
Right. And I think the other thing is we believe it can, it's a risk, it's a less risky investment in equities at best.
Yes. So people are saying we entered 2025 with the Magnificent Seven. I actually did it for the top 10 names. The top 10 names accounting for 38% of the entire S&P index. So that's 10 out of 500 names accounting for 38%. Those names were up 65%. So there you have, the majority of the 24% gain in the S&P.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe. It really helps us grow the podcast and bring you great content. Thanks for the support. And
I just mentioned that because not only were the PEs high, Bill, and you know this better than most because of the nature of your research, but I think and the question is, do people look at the concentration of those returns, not just the relative valuation, which is almost, twice that of Europe coming into the year?
So do quants look at the concentration of, is this market
Of
breadth?
market breadth. That's
Yeah.
the term, right, that we would use.
So we talk about it and we read about it. I think there were plenty of headlines over the last few years that the Mag 7, drove the stock market.
Yep.
And interestingly, when that happens, those are just beta names. You end up sometimes shorting those stocks because they're a cheaper alternative to shorting the market. So when Apple has a super high beta, you can just short Apple rather than short the S&P. So it's very nuanced, and I think that there definitely are examples like that. And typically you're going to be hedging. Hopefully, you're not hedging the S&P. You're hedging, the first principal component of the market.
Yeah.
And I guess I'm going off on a little bit of a tangent, but within you have sector specific models that will definitely do relative value within tech. For example.
So it'll be captured in other aspects. The market breadth being narrow, meaning 7 names are driving 70% of all returns. That's just deemed to be beta, and you may use that as a short and go long other things.
Right. Yeah. So maybe you implicitly end up using that as a tool. But yeah, that's a very nuanced, complicated question. I think everyone does research around, does this sort of microstructure or economic indicator impact these types of models? And, again, looking at sector specific or risk premia specific models, relative value, a lot of time you can use, such things as market breadth and say, when market breadth is tight or wide, does that have an impact on this factor? And those can be good tools, and quantitatively driven, you might raise or dial down risk. So maybe that's the best answer. I think when market breadth is wide, you have more confidence in relative valuations, cross-sectionally across stocks.
Yep.
When they're very tight, that sort of means correlations will be higher.
Yeah.
Especially in this case, it's a small portion of a sector, and also within risk premia. So I think momentum, growth, tech has been really tight lately, and I think that does implicitly get expressed in models.
And looking at some of your research that you guys have been doing at Harmonic, it looks like we've seen some of those factors blow out at 2 and 3 standard deviations.
Especially recently, yes. So these moves have not been well predicted. I think that's basically what it means.
I guess the term that we've talked about is it wasn't in the data.
It wasn't in the data.
And so I just had to pull this up because this was not in the data. I mean, look what we're showing our audience here is the Atlanta Fed 10 years ago started this thing called Nowcasting, which is done across industries. It's basically getting input on a more regular basis to predict an ex ante or an ex post, rather, fancy word for a metric that is released after the fact. Like the first Friday of every month, we have employment for the prior month. That's ex post. what we're trying to do here, and people is they get data that is within the days or weeks or hours, and they try to estimate what had been a metric released weeks later. So look at what the blue chip consensus is for GDP per the Atlanta Fed's sampling of, say, Wall Street. It's like what you did, Bill, with the consensus and we saw that Wall Street was off. I mean, this is actually a pretty neat segue.
And so, yeah, I think my forecast going into 2025 and the ETF recommendations, I wish I could now cast those because they were so bad. And I need to put a disclaimer on my research from now on that says I'm only expressing the opinion of others.
So,
I'm not responsible for anything that I write.
Are you Irish Catholic? Because your guilt is almost as big as what I grew up with, and I wouldn't look at it as any mea culpa. What you did is you unleashed your LLMs on a body of work, and you gave the audience what the consensus was. And I think that the benefit of that is, as it started to stray from consensus, that should have been and was a signal, and you talked about it, about, hey, gang, we're not going where we expect. And we, Wall Street, the consensus, have an impact on the market. And when that deviates, like why I still have this graph up here, this was not in the data. The blue chip consensus is like what you saw it was related. It was the same house, the House of Morgan, Bank of America. That's the blue chip consensus. And they were wrong. They were wrong on earnings. They're wrong on the economy. And we haven't seen this move in a long time. So that's why I think there's more to come. And the reason I'm asking you about the quants is because, people are fearful, or the boogeyman of a very levered quant all of a sudden goes low to ground and causes a knock-on deleveraging and contagion. I don't know if we're there yet, but we certainly got the recipe.
Yeah. So I guess a few things. I did go to an all-boys Catholic school in Danvers, Massachusetts called St. John's Prep. Go Prep. But I think there's so much going on. It's so crazy. My research may end up with a disclaimer that's just a little bit bigger in the future, but and I think what I would actually like to do is just update, my research more often. And I think that's what nowcasting really is.
Yeah.
It's like, okay, now that we've got more data and here's what we're going to say. And we saw, the Merrill Lynch portfolio managers survey, like all of them are long Europe now. Oh, it's brilliant. Like you get some returns in January, you're like, oh, now I like Europe. You get better returns in February. You're like, I like Europe even more. And so everyone kind of reacts to the sentiment in the market. And it's increasingly apparent to me how much sentiment drives everything. And that's, Wall Street expert forecasts, portfolio managers, hedge funds. But should people be fearful of a big deleveraging? I think that only happens when something blows up fast. So a large quant fund that, last week we were talking a little bit about like a drawdown where you basically just sell off a portion of everything. That happens more gradually. And I think it has inevitably been happening since this has been such a crazy, volatile, unpredictable market. And, I was looking, hedge fund returns were down. And I think it goes without saying that a lot of them were quants, especially like in the high frequency space where, I saw Jane's down. There was an article on Bloomberg, Citadel was down, Millennium's down. So I have a feeling the majority of hedge funds have had a rough year because it's been so unpredictable, and they will take risk down, which means, you basically just sell off some of everything. You literally deleverage the whole portfolio. So that
That's
happens
that's that
gradually.
slice you talk about. Just take a slice across the board.
Yep. And so that adds to the negative performance of the whole market.
Mm-hmm.
And then if a place blows up quickly, then you see a market event, and we may have had one or more of those recently. It's hard to tell, and we would always speculate, and like one advantage of having your own data is if you see your whole portfolio get hit, especially in the factor space. So like if all factors just go bad, you can sort of intuit that some other quant sold everything.
Yeah.
And if they sell a lot of everything rather than just the slice, like the slice will be bad. It exacerbates, losses across factors.
Yeah.
But you'll kind of notice when it's outsized, and then you'll read about it in the news a couple of weeks later or something. But
so that's what you just said in the quant world about a factor. In long short equity, it would be obviously a sector, and that's that dynamic I call one water table. People realize that there's a shared position when all of a sudden it has that 3 standard deviation move, and they don't sell it, but it's down because their neighbor sold it. And so then it's like a game of, it's game theory on who's next. And there are two periods in particular I bring up, not as analog, but it's just as illustrative. And that would be going into Brexit, 2015 into 16, when you had China devalue, and you even had that weird thing happen with the ETFs where there was a bad pricing in August and like things were down 30%. So you had some market disruptions, but then you had the absolute just puke of oil going from 104 in late 14 down to $25 in January of 2016. And so that was a macro event. Energy was about economy, growth expectations dropped. I mention that because I think we have an early feel of that kind of drop in oil, growth expectations lower, but we're nowhere near capitulation, I think, on the rates and energy and currency side, but the rumblings are there. So I don't know if you know of another period or where you think macro factors impact, or again, am I asking still from my global macro chair, asking you a question where you say, well, we don't care about oil, but we look at factors that oil impacts and to see if that rolls through. Is that the fair assessment or otherwise?
So I'm starting to think that we need to do 2 podcasts this week. So from a macro perspective, I think that, let's just talk about oil. So oil's an interesting one because that, typically should help you predict energy stocks. And, if you were to look at data that drives energy stocks, the price of oil is, very important, especially if you're looking at oil and gas, companies that are extracting oil from the ground. The risk of the company's balance sheet is either under the ground or,
Yep.
into transportation.
Proven or refined. Yep.
So where am I going with this? Within sector bets, things like that can be important. And then, there are factors. So like Wolf Research, for example, has a sensitivity to oil price factor. And I think that's a better way of doing it than, doing a sector bet. I think energy in particular is very difficult to predict. So that's just a bit about oil and energy.
Mm-hmm.
What else were we asking there?
Well, we're talking about the macro impact, and we touched on, I guess I'm playing my own tune here about. I recently wrote, rocks before sand, and how when things get really tumultuous, you have to have a come to Jesus about what your process is because it's being tested. And the first principles of risk management, obviously, identify, measure, manage is what you do. And in the priority about what you identify, measure, and manage, it's going to be rates, currencies, and credit. And the reason why that is because those are usually highly levered, low volatility assets. And when they break out, they really cause a ruckus because the expectation of, think about the currency break between the Swissy and the euro. That was not expected to happen. 20% move. It took people out.
I remember exactly where I was and when I heard about that. That was so that low volatility trade that changes overnight is like the quant nightmare.
Yes.
You basically, you're going to over leverage that trade because of the low vol. And then there was like,
people call it a Lindy effect. It'll keep happening. People love persistence.
But I love that example because it is one that is, well, we didn't love it at the time. But that one is one that was an uneconomic volatility, right? So the volatility was dampened because it was literally pegged. Like the trade couldn't reflect the actual value of the Swiss franc versus the euro or the US dollar. It was pegged. And so everyone over leveraged that trade. And then all of a sudden overnight, it was no longer pegged.
Yeah.
So the volatility just spiked and everyone.
So Bill, hold that thought because you saw it from a different position. The fundamental person or global macro, and Scott Besant, relevant because that's where he comes from. He's a student of Japan and Kuroda. He's a big fan of. He was there when Soros, in the room when Soros broke the peg between the pound and Soros made his $3 billion. So he understands that. In the Euro Switzerland's, I think that their bank reserves were approaching in excess of their GDP.
Yep.
They just didn't have it anymore. I mean, that would be the equivalent of the Fed's balance sheet, currently about $7 trillion, going to what, 28 trillion?
And there's your relative value trade. You were betting long Swiss, short Greece.
Hey guys, if you got anything out of that last segment, don't forget to like, comment, and subscribe, as it really helps us grow the podcast and bring you great content. Thanks for the support. That's it.
Now, and you were saying that this easy trade has no volatility, so let's just dial it up. Let's lever it, 20, 50 times or something. And then
right. A 20 or 20 or 50 times as a former risk manager, it gives me hives. So that's why we are having this podcast, because I won't speak for the quant. Well, I'll tell you my observation about the quant, having worked with them, only seeing it. And you worked there. It's in the data. We'll manage down. We'll wait for relationships to reorient, and then we'll reengage. Whereas a fundamental person doesn't look at the data, but looks at, say, financial statements. They look at economic factors. They look at personnel changes, like a baseball game. Who's pitching? And right now, Trump's on the mound, and we're not sure if he's accepting the signals from the catcher. Right?
Isn't he supposed to be the manager or something anyway?
He's playing. Some people think he plays every position. But what we have right now is we have uncertainty in the marketplace because we have a ball game going on where we're not sure of the rules. They're being changed. And in fact, so much so that even though we've had changes, we had inflation, again, that's why the European equities are higher, because they have to print more money, because Trump is changing the rules. He's saying we're not going to fund military anymore. Everyone's got to pay their fair share. Germany's reacted. MERS, new player there, has said, all right, we'll do that. We're going to spend money that's not going to happen overnight. So there's a lot of uncertainty going on. And going back to the Euro Swiss, the risk reward in that trade for a macro person was I'll bleed out, say unlevered because you like the risk reward. I'll bleed out 1% maybe a year, but I can make 20. What's the probability of that? So that's what a fundamental macro guy or gal does is they play that asymmetry. And right now, there is no certain trade going on in the marketplace. Everything is upended. If it's okay, I'm going to go to one more screen switch before we
go for it. And I'm
close up here.
I'm going to maybe have Buster make a guest appearance today.
Yeah, don't think dogs don't feel it. Buster knows the pain. So what we have here for the people who are able to look at us on YouTube, let's start with the winners. In 2024, we talked about, it being all about Mag 7 and US. US markets dominated. But now look who the winners are year to date. Excuse me, flipping through here. Year to date, 1, 2, 3, 4, 5. The top 6 equities, per our sort on the Koifin database, was non-US names. China, Alibaba. China was left for dead. Absolute reversal. And if we then go into the losers, 1, 2, 3, 9 out of 10 are US. It's been an absolute reversal of names. Again, we talked about it ad nauseum, but that's why people are saying, is NVIDIA still useful? Yeah, but maybe not at the multiple. So there's a bloodletting because when things get hot and markets go sideways, people get low to ground, whether you're a quant or a long short person. And that's what we have going here. And I'd be obviously remiss not to mention or show what's going on in digital assets. Here's the crypto fear and greed index where we use the Bitcoin price to show the price against sentiment. And sentiment is obviously very poor. And it's along the lines of what we've seen in other periods where bear markets were taking hold, but also prior to bull market runs. So we're still bullish, even though we have a current negative outlook. And what I want to show here is what's happening in digital assets. I'm a bull in Bitcoin. I think that it is a store of value. I think that, and I think we show even in 2025, it had been a diversified mitigant, even though it's down to a portfolio. So how I'd look at this is that XRP, which is more like a business with Larson and Garlinghouse corporate heads, they're really trying to get in with Trump and the administration to say, let us be the protocol for banks. What I believe and what the legislation shows is that the focus is going to be twofold. And given what came out of the digital asset conference, where only Bitcoin was put in as a strategic reserve, with the other assets were put in as a stockpile, that bifurcated approach, I think, is why asset managers like BlackRock and Fidelity are focusing only on Bitcoin right now for portfolios. The second point that I'm going to bring up, just because I got to mention it because of the digital asset conference last week, stablecoins. And we mentioned in our Substack, stablecoins are going to be the number one legislative objective for 2025 because the banking system, it's a new business line for them, and stablecoin adoption creates a brand new buyer for U.S. treasuries. And as we said at the top of the call here, Bessent needs to refinance 10 trillion in treasuries. And that does not include an additional 2 to 3 trillion of additional treasuries in order to finance the deficit. So that's my call for digital assets. It's Bitcoin first, stablecoin second.
So I think we do have to wrap soon, and I actually really do feel like we could almost talk for hours today.
Buster looks like a trader ready to go for a walk because he's losing his mind in this market. Fair enough.
He was making a lot of noise, so I went and got him. A few things. One, I think this graph maybe is another one that we have to remind people to be careful about their data, because we were debating whether or not XRP is up year to date, and depending on where you go, you may get a different answer. I did want to also I lost my train of thought earlier when I was answering the question about deleveraging and quants. Another tool that quants are all using now, I think, after multiple times of getting burned over the last 10 or 15 years, is, you'll have an indicator, crowded longs and crowded shorts, and that's one factor that you would use to avoid getting into this problem, right? So like single stocks, if they're just widely held, you have different ways of figuring that out. You'll use that as a hedge. So hopefully that's managed a bit, but then everyone's going to be using that factor too, and there are data vendors that provide these things.
Yeah, we had that at Credit Suisse. It was a sought after metric to see.
Yeah, I mean, for obvious reasons, like you don't want to hold the crowded momentum stock when everyone unwinds it.
Yep.
And so I think last week I said I wasn't panicking. And quants should never panic. You set it and forget it, more or less, and you trust the process. Most importantly, it's not just statistics; it's a lot of process around it. You don't react. Having said that, I'm looking forward to some good news, some better news. Just because when I look at my own retirement portfolio, which is long U.S. equities, and probably will be for the next couple years anyway. I try not to look at that. Actually, maybe that's the real answer. Don't look at your 401k until things get better. Things will get better, but don't look at it right now.
Year 2010, you mean? That's what in 08, I think that term was coined. Yeah, so maybe this is, as you said, a good time to wrap it up. We'll sum it up by saying third inning, 10% correction. If we print negative like we see with the Nowcasting, great tool. Chance of a bear market are, I think, above 50%. Not investment advice, but just looking at historical. A down print. Recession requires 2. The question is, will Trump pull this economy out of the nosedive by agreeing on trade terms, which will again take time to move through, or will the Fed have to come in because something breaks, like we saw in March of 23? So there are some things to get us out of this, but if it goes back to the same game, Bill, of money printing, that's good for Bitcoin, bad for wage earners, and not good for the general economy because it's a narrow attribution. I think we'll call it a print there, unless you have any other ideas you want to leave people with.
When I looked back at historical recessions, there really was a very short recession in 2020, and that was purely only the result of printing money. Will we do it again? Do we have as good of an excuse? We don't have as good of an excuse, but I think we'll do it again. So,
all right. The print is on. Thanks a lot. Oh, and please don't forget to like and subscribe. Hit us up on the chat if you have any topics you want to discuss, or visit our Substacks. Bill's at Harmonic Insights, and I am Mark R. Connor's Market Insights podcast Substack. Thanks all.
yeah. Thanks all.